Greetings and welcome to the Remote Real Estate Investor. On this episode, I'm going to be joined by
Emil Shore
and Michael Albaum.
And today we're going to be talking about a trend over the last couple of years where a lot of money is flowing into the space, specifically of single-family rental investing, specifically from larger institutions. So today we're going to give our opinions on what's good about it, what's bad about it, what are some advantages that they have versus us as individual investors, and so on. So, all right, let's go ahead and jump into it. Awesome. So before we get into the topic of hand of discussing institutional capital coming into this space, I feel like it's been a while since we've checked in with each other on what is going on with our own portfolio and all of that good stuff. So, Michael, I see you nodding your head on the video screen, so I'll let you. That is your trigger for you to go first. What's going on in the Michael Albaum portfolio life world?
Right on. So a lot of different moving parts. So in contract to sell a 12-unit mixed unit property that I own with a partner. We were planning on keeping it as a long-term buy and hold, but the market went crazy and it's kind of a headache property anyhow. So we just said, let's sell it. So we're making a decent profit on that and we're 1031ing it. And I have a property under contract out towards the East Coast, further east than I've invested before for a short-term rental. And then I have some additional capital that I need to place as part of that 1031 as well. And then I am also in the midst of two flips. And so I have one actually under contract for sale.
Were you thinking of parking that, the 1031 proceeds?
Some of it's going to be out in Tennessee. And then for that short-term rental. And then I got to find some place for the rest of it. So if anybody has any great suggestions, I think there's about $100,000 that needs to get placed.
Nice. More multifamily mixed use stuff?
I'm not sure. I
TBD?
think for that piece of it, I'll probably just do a single family.
Nice.
Just go buy a single family all cash somewhere. So that's the plan as of now. And then I've got two flips underway, or the construction's completed. So I have one that's actually being sold on Roofstock. Currently, it's under contract. And then I have another one that should be getting a lease signed any day now. And that'll be sold through Roofstock as well with a tenant in place.
Awesome.
So all kinds of moving parts.
Nice. Hey, Emil, and yourself?
So I don't remember my last update, but I think I was talking about the Triplex. We had the 1-bed, 1-bath, and getting ready to be renovated or just repaired, renovated, whatever you want to call it. So we finished that. Ended up, there was a bunch of the tenant before was a smoker, so we had to do a couple coats of paint. Had a lot of patching to be done. We ended up replacing the kitchen cabinets and a bunch of loose ends here and there on the inside and outside of the property. So that just wrapped up. And so my property manager is marketing that to be rented right now. And then this triplex was actually a 4-plex converted into a triplex. So one side is like a stacked 1-bed, 1-bath. The other side is like a townhouse 2-story. That tenant just left the other month, which is actually great because it's a 3-bed, 2 or 1.5 bath. So the rent is probably a couple $100 under where it can be, especially with the market rent starting to go up a lot recently.
Nice.
So I just approved a bid from a contractor yesterday, and we are about to get underway making repairs there and getting ready to rent out. So it'll probably be another 4 to 6 weeks if I had to guess.
Nice.
A lot of action, guys. I'm kind of in a boring position. Which is always a good thing as a remote investor. Like boring is good. So I did a couple of cash out refis with the great rates, all that good stuff. And right now I am recording in my office, which is our extra bedroom, but we're in the not too distant future going to have another baby moving into it. So I'm losing my office space. And these days it's really important. So my real estate, activities is more around building a little studio shed on my lot. So there's a lot of really cool prefab companies that do this kind of stuff. So going through that rigmarole of hopefully the Contra Costa County Planning Commission is on the call, debating around permitting it or not. I mean, it's not going to have whatchamacallit, like plumbing or anything, but it will have electrical. So basically working through contractors and site planning and kind of working on that type of fun development. But I think there's probably some real sweat equity to have, like within the house that I'm at now, adding an extra, detached little office. So hopefully I get my money back and some at the point at which I decide to sell my place.
Totally.
I've been wondering about those, Tom. So you have to get some type of permitting or approvals for the prefab stuff that doesn't have any plumbing? Like I thought they just came in kind of like set it down and you're good to go.
Yeah, I mean, I think the city would want you to permit it. From talking to my contractor, where you can get yourself in big problems is related to zoning and like setbacks. So like, let's say I build this and I don't get it approved, and then for whatever reason, either they find out or come. If the building doesn't have the proper setbacks, then they can make me rip it down. But if they don't, they just might never approve it. I could be talking out of my bottom, and hopefully we had the right disclosures at the top of the episode. These are all opinions and not necessarily facts. But I'm making sure that I'm nailing the zoning stuff right and doing it if I decide not to necessarily to permit this little unit. I don't know. The other consideration is permitting. So when I sell it, like it has that. But kind of funnily, when I looked at a house earlier, maybe like 2 years ago, they had a little unit and I didn't ask if they were permitted. I mean, I guess maybe I should have, but I think the bids were still competitive, taking that in consideration that, hey, this is up and working as an additional outside office. So I don't know. We'll see. If anyone would love to comment on should Tom try and permit his little studio shed, that would be greatly appreciated. All right. Back to the topic at hand, and this is a great Pierre, excellent idea for an episode today. So the question is: are institutions, so big private equity that's coming in buying single family homes, are they crowding out individual buyers such as ourselves? And the way that I think I love to shape this conversation is to give kind of an equal measure, looking at both sides of the table as an investor. I think with other people in the space, it can be sort of a double-edged sword. And I'd love for Michael, why don't you lead us off on this discussion in talking about, as an individual investor, how do you see institutions helping you, not helping you in just kind of in the ecosystem of this single family space?
Yeah.
Go ahead and lead us off.
So I think I'll start by talking about the positives first, by some of the real benefits that we are likely to see, if not seeing already, from iBuyers institutions coming into the space. So for one is institutions don't make it their business to let properties become dilapidated. So they'll often buy properties and then fix them up with a lot of CapEx, make them nice. And so if I'm invested in that same market, or even better, in that same neighborhood, my property is likely going to be seeing a lot of appreciation because these other properties in the area are being brought up to snuff, and maybe even nicer than my property.
Not just appreciation, probably rent growth as well. I might be stealing your next bullet point, but I think that's really tightly that you're seeing the benefit from.
Wow, Tom. I had my linear path and you just cut me off at the knees.
I know. That's what a good leader of the episode does. Is just tears down the other people. Go ahead.
Takes all the glory for himself.
That's right.
That was a good idea, Tom. Good thought, Tom. Rent growth. Go ahead. Continue.
Last time I share episode notes with you. I think that there's neighborhoods that are being improved greatly. And I think that there's a misnomer and a common misconception when people hear the word landlord or property owner. And it's, somebody owns a slumlord, they let it become dilapidated, a lot of deferred maintenance, park cars on the lawn type of thing. And so these institutions are in the business of making a return and are, I think, likely in it for a longer period of time than some in mom and pop landlords. And so they are injecting capital into these markets, serious capital into these markets, and a rising tide raises all ships. And so if you happen to be investing in those same markets or have previously invested in those same markets, that can be a real big win.
I like it. Emil, do you want to add any other initial commentary on the
pro side or the con side?
I'm going to let you take it where you want. You know what? Also a good podcast leader. It gives
flexibility.
Take my fellow co-host, explore the space. Take it where you want.
Okay. All right. So, I think it's one of those things that it just depends on how you look at the world. I think they do a good service in that they provide a floor, right? Back in 2010, 2013, when prices just kept going down and down and down, that's when institutional investors came in and really created that bottom and started scooping everything up. And like Michael said, fixing up a lot of these distressed homes, bringing them up to code, whatever, making them nice and converting them into rentals. So I think the same thing could be said now. You have a lot of institutionals who are interested in the space. They create a price floor for us mom and pops. So that's good. I think it gives you some reassurance that this is maybe a more mature asset class than it used to be, and that there's a lot of money waiting on the sidelines. So if things go down a little bit, it's not going to crater as much because some institutional money could come in and again, create that price floor. So I think that's one of the positives. Also, I remember reading these headlines, like no one really providing data. It was kind of just anecdotal, hearsay stuff. And so this Vox article that I just pulled up, let me pull some stats from this. So this is from Lori Goodman, who is vice president for housing finance policy at the Urban Institute. One of the things she mentioned is that as of 2019, institutional operators owned just 300,000 single family units. So, I know they're putting more pressure to buy now, but you can just see there's such a small percentage. And for context, researchers point out that there are roughly 15 million one-unit detached single-family rental homes in the United States. So a very, very small fraction are still owned by these institutions. So I think it makes all these, salacious headlines, but if you dig into the data, they're really not scooping up the lion's share of properties. It's still owner occupants, mom and pop investors. So I think a lot of it was, clickbait headlines trying to get people to outrage, outrage sells. So I think that was part of it too.
Yeah.
Emil, that's a great point. But I also have to ask, do you have one of those like word of the day calendars on your desk? Because salacious is not a word that I've ever heard you use before. So curious to know if it's part of your daily lexicon.
No, Michael, it just came to me as I was exploring the space that Tom had asked me to explore.
Wow.
Sometimes I'm a learned man and I use words like salacious. So leave me alone. Okay.
I should explore spaces more. That's on me. My bad.
So I'll add a couple of more points in the pro column as it relates to institutions coming in. So one of them is, I love your point, Emil, about providing a price floor. I mean, in, family friends talking to me, hey, aren't you concerned if there's a huge, drop in the value of the homes? It's like, no, so the rents stay fairly stable just because they move very slowly because they're on long contracts. And as a basic function of looking on what the return is, with the institutional money that's out there, they're going to pick up whatever, goes to sale if it's below a certain dollar amount. So I think the price floor is really important. The other is the liquidity aspect. So I'm sure, I don't know, I've received a lot of different mail and, from like Open Door and some other like bigger companies coming into the space. Maybe Open Door isn't a great example just because they're buying just to sell. They're not necessarily long-term buy and hold. But what they are providing is more liquidity if they needed to move pretty quickly, either on a 1031 or whatever. The other aspect that I didn't hear talked about by you guys is better information on analyzing markets. So with the institutions getting involved, they have a lot more data, if that makes sense, in like a single place. And there's great research folks out there like John Burns. If you haven't heard of him, please look him up. He's been on the podcast before. He's sort of the economic thought leader in the SFR space and puts out these reports with tons of really good information on markets, on like the top 50 or so markets. And a lot of that is made possible by the aggregation of data. So as a buyer, individual buyer, when I'm looking at potential markets to buy in, I'm going to have a lot more color on the type of return profile by these different markets because of the aggregation of the data on those institutions. So I think that's been another boon or benefit of just kind of the lights being turned on with regards to these different markets where there's good institutional concentration to be able to see how those are performing.
So are you suggesting like to ride the coattails kind of the institutions that hey, if there are these big institutional players going in, they've clearly done their homework. It could be a great market to invest in.
Yeah, I think that's definitely can be a strategy to do in exactly like you said, these other people that are doing their homework. And honestly, though, if you want to avoid that, you can just buy in smaller markets because a lot of these institutions, you're only going to find them in these Class A for the majority of them, and maybe some Class B, I guess, or when I say Class A, Class B, I'm thinking more market size. I don't think I'm using the right verbiage, but like tier 1, so like the Dallases,
tier 1, yeah.
Exactly, versus some smaller markets. There's going to be less institutions if you do want to avoid them. But all right, let's go ahead and continue the conversation. I'd love to hear some thoughts around negatives with institutions coming into the space. Emil, why don't we change the order up, and why don't you go ahead and lead us first?
I'm just going to have to point to anecdotal stuff, right? Like an institution. And if you're to believe these headlines and these articles that are saying institutions are coming in, iBuyers are coming in and way overpaying for properties, that could be the case, right? That could be one negative. Maybe they don't know the market as well as, you or I, who is looking at the same market every day for years, right? And we know what an appropriate price is. They could come in, they just have a lot of money. They're looking at an investment in like a 5-year, maybe 10-year time horizon. And they're like, oh, it won't matter. 5-10 years, we think it's going to go up X%. So we want to win as many properties as we can. We have a lot of capital we want to deploy. So let's just throw a lot of money. So that could be one of the negatives, is they're coming in and they're willing to outpay you or I. So that I think is the biggest negative when you see things like this.
I like it. Yeah, deep pockets. Tough to beat that out in acquisition. Michael, go ahead.
Yeah, I think just to echo what Emil was saying, I think one of the reasons it's so difficult and they're able to overpay so much is, one, because it's not necessarily their money, so to speak. Like they have investors' money that they're playing with, it's other people's money. So there's a bit of a detachment there. And then also they have access to debt facilities, or if they are borrowing debt, they're able to do so at a much cheaper rate than you or I. And so they're playing kind of with a different set of rules, trying to play the same game that we individual owners are playing. So that makes it really difficult to compete. And then also, Emil, like you mentioned, that price floor, I think that can be perceived as a negative too if someone is in a purchasing mode or a purchasing phase. If I'm waiting for a downturn or I'm waiting for a market correction and there is a blip on the radar, minor correction, these institutions might swoop in and prevent the prices from falling to a place where I might want them to be or need them to be in order to get involved into the game or investing in real estate. So I think it's both a pro and a con, depending on which side of the equation you are. If you're already an owner or if you're a potential buyer, that could be perceived as a real con.
Pierre, I'd love to hear, you came up with this as a topic. I'd love to hear your thoughts on either side of the coin, pro or con.
Well, to the point of the proportion of the market that they are buying up, say there's 15 to 20 million homes on the U.S. market, and they are only, Emil, was it 300,000 that you said?
Yeah, but that was as of 2019, just to reiterate.
So at that point in time when that measurement was taken, that's not that big of a market share. What about in 10 years? Is this a trend that is moving, that will continue? And I'm not about anyone being regulated out of a market, but just as a concern, will this continue to grow and take up a larger market share as time goes on? So that's one concern I have. The other concern is I'm not that worried about it from what I've seen. More what I see to be a bigger issue is the restrictions around building in certain markets, keeping the housing stock low. So that's kind of my pro and con there, is what's the future going to look like? And is that actually the real problem? Are there other problems driving housing shortages? I
like that. Option C on other reasons why maybe there's just not enough houses and it's kind of artificially being kept low. I like that. I like that out of the box.
Tom, what about you? Yeah. Share your thoughts here.
I know. That's the great thing about being the host. You can kind of pass the hot potato around.
Sneaky snake.
And just interject, Michael, when you have a really good point.
Yeah, I know. I could just see exactly where his point is going. Yeah, I'm going to just continue to jump on. Just call me Jansport. Michael's going to carry me, but I'm going to twist it up a little bit. So, Michael talked about like debt facilities being different. Different, much cheaper insurance because they're just getting much larger scale. The other big advantage that institutions have, and I'm not saying this is necessarily like going against me as an individual buyer, but institutions have access to these portfolios that, let's say a seller only wants to sell it for $100 million and they're going to get a much better discount on these individual properties. So as an individual investor, some of the deals that these institutions are seeing, you'll never see them because they're just so out of range on what that purchase price is. And you have these compounding effects that make institutions having this like advantage in the space. Like one, better deals on individual properties because they're able to spend $100 million at a time to buy the huge portfolio. And I'm not saying this is bad. I'm just like, making commentary. So, and then they have advantage to cheaper other type of costs that are involved, be it insurance, maybe even internalizing property management, seeing how that looks. So there's a lot of advantages that an institution has against you as an individual investor. So the next place where I want to take this conversation is, what are some advantages that you as an individual investor potentially have over a larger institution, say, in buying in a market or whatnot? And Michael, I see you shaking your head a little bit, or maybe that's the breeze or something blowing against that mane of hair that you have. Why don't you go ahead and lead us off in this train of thought of thinking about kind of advantages or ways to mitigate in a market doing acquisitions with other institutions?
Yeah, totally. So as an individual buyer, I think you have the ability to get really granular and really specific and really personal with the people operating in that market. For instance, I doubt that an institution is going to call up 5 local property managers and ask them their opinion about 5th Street or 10th Ave. They are going to be using data, like you mentioned, Tom, aggregating that data to get an idea of what that market is. So if we simply pick up the phone, which I've always said that there is really no substitute for doing, and having conversations with real people who are operating and living in that market on a daily basis, you're able to, in my opinion, get a lot more granular. And so even block by block, a lot of some of these markets have massive differences. And so when you can pinpoint that and get down, again, there's no other better word for it, I think, than granular, you can get very precise and very accurate with the types of properties you're buying and the physical locale of those properties. And so I think that that's a massive advantage that we as individuals have, because I just don't see the data being that granular yet. And maybe they're using data that we don't have access to. My guess is that they probably are. But from a property by property basis, block by block basis, I just think there's no substitute for local personnel.
Totally. Love that point. Emil, do you have any other thoughts?
No, I think Michael took the important one, right? You are somebody who, like I mentioned earlier, you're looking at that market every day for years, hopefully, right? Like you're going to see things and notice things that an institution is not, because they're just looking at aggregate data. Maybe you see a property that, I don't know, is 3-bed, 2-bath, but it's like 300 square feet bigger than all the other 3-bed, 2-baths. And you could potentially convert it into a 4th bedroom or something. Like these things that you only pick up after just knowing that market, knowing your properties for a longer period of time. So I think it just, may require you to be more patient and have a little bit more skill in analyzing deal by deal. But I still think you still have plenty of advantages as an individual.
Yeah.
I was going to say one other advantage that I think individuals have over institutions is that we are individuals and we are people. And this applies more so for your mom and pop sellers or your kind of one-off sellers. So we as buyers can really humanize ourselves and often have interactions with the seller and approach it from at a human level and kind of human connection. And so this is something that my wife and I did on this 1031 property that we're purchasing. We wrote a letter just talking about our background, who we are, what we want to do with the property, why we think we'd be a great fit to buy it. And the seller said, look, I want you to have this property, even though there were other tours and other offers, I believe. So when you can connect with someone kind of on that human level, I think people like doing business with people they like, versus I am the institution, this is the price kind of a thing. I don't know why all institutions have robot voices, but that's kind of where I went with it. And so I think just, again, humanizing the deal and humanizing yourself can give you a massive leg up over more professional investors.
I think my point that individuals have over institutions is a longer term lens of a strategy, where institutions, they may turn on the acquisition and then turn it off. And I remember in working for one of the single family REITs, our price of our stock would go down, and it had like nothing to do with necessarily performance of the properties that we owned. It could have had something to do with, who knows, like what other secondary aspects of the market, and that could impact, okay, when we're doing acquisitions or when we're buying. There's just this long game of telephone, like with bigger institutions on making decisions, where you have this longer term view, in that you can sort of not beholden to this like longer term chain of circumstance, which an institution may have on when they're selling a fund or when they're buying a fund, where you can be ultra opportunistic, having long-term vision on when to buy, when to sell, and time it out, for what's optimal for you versus what has happened in these like secondary factors, if that makes sense. So another point that I made earlier is there are a lot of markets that are not as saturated with institution. Perhaps there's a reason why there's less institutions there. For some of them, it could be just a population thing where they're just looking for bigger markets. So you're much more nimble and agile as an individual investor in moving, right, in spreading out longer terms on when you want to buy, when you want to sell, changing locations. There's just this agility as an individual investor that you have, and a good analogy another way to think about it, kind of similar to Michael's earlier point, is, while a lot of these institutions are using a lot of data and they're kind of firing, executing a little bit more as a shotgun versus like a sniper rifle, where with you as an individual, you can spend a little bit more time massaging each deal, understanding each stuff. And there could be times where you run into a brick wall, as in the institution that you're competing with and buying a house just, has way more money, but who knows, next month they may halt buying for whatever reason that they do. And if you can be patient with your strategy, I think it tends to pay off in having that longer term horizon.
That makes total sense. Emil, did you remember that we were talking to the enemy here, Mr. Reitz, Mr. Former Reitz?
Tom, Mr. Former Reitz Schneider.
So Tom, I'm curious to get your perspective, because you did used to work for a single family REIT. So you were on the institution side of things, and now you're, of course, on the individual side of things. So very curious to get your thoughts around, what tools, advantages you think you had over the individual investor, and now do you feel handcuffed or less well equipped to participate in the space?
Sure. So I think from an acquisition standpoint, getting access, as I mentioned to before, of these like big portfolios to look at and to underwrite and buy was a big deal. I mean, I'm probably going to be regurgitating a little bit of some of the stuff that I talked about earlier. So access to doing that type of an acquisition, because you're definitely able to get a little bit of better discount to market in doing that type of a transaction. On the hamstring thing, I think there's sometimes with, as I said, like a big organization, you may make decisions at certain levels that don't make sense all the way down to the bottom. Like, for example, like there was this concept of like turning over capital where we would just sell properties to recycle the money to come through. And it's like, these are great properties. I remember I worked in acquisitions for a little bit, and some of these properties I had bought and they were like performing awesome. And we sold them. They probably, doubled in value from the time that they sold them in whatever 2016 to now, or maybe even more. And it's like, why would that institution sell that? I mean, I guess it's great now. It went to either an individual investor or to an owner occupant and being sold on the MLS. But it just sometimes there seems to be decisions made that if you were down at the ground floor, you necessarily wouldn't make, in working in one of those institutions. What is interesting to think about for me, so I left that company to come work at Roofstock in 2016, and that's a lot of time to have improved processes and improve the technology. So I think institutions have an advantage in applying a lot of resources to getting more efficient as just like a big mechanism. So I'd be interested to see how some of those companies are running now as it relates to some of these, in underwriting properties and how much that has changed. I think there's, definitely opportunities to have a bigger advantage in continuing to iron out those practices and best, technology that support it after so many more years. I think the big piece is agility as an individual versus an institution. Is agility and kind of getting able to, in buying a property, there's always some unknown unknowns. And I think as an individual, you can go a little bit deeper into answering those questions, be it like getting to know the local people better in that area. If you're just focusing on that one property, there's just that much more of an opportunity to go that many layers deeper in underwriting a property and underwriting a market and underwriting an individual neighborhood. So I'd say that agility aspect is really is something that we need to take advantage of as individual investors.
Mm-hmm.
I guess as a super high level recap, and if you guys want to fill in, I think we both see institutions as a little bit of a double-edged sword, but I think altogether I would put them more in the positive camp, just in the stability that they provide to the market in providing a price floor and maybe pushing rents a little bit. But again, it can definitely be more competitive on the acquisition side. And Michael, I'll let you fill in some gaps. I see you wiggling around over there.
Well, I just this analogy just came to me, and it's one of an ocean. And in the ocean, we have sharks. And a lot of people are terrified of sharks. They don't like sharks because they are competing for their same food source. And they also are can be harmful to humans in some instances. But they're also a necessary part of the ecosystem. And if we got rid of all the sharks, we would likely see the collapse of our oceans. And so it's a necessary evil is the wrong word, because I don't think sharks are evil, but just as in thinking about some of the dangers or fears around getting in the ocean, could be applied similarly here. There's some maybe danger and fears around getting involved in the single family real estate space. But I think that the institutions are definitely necessary for all the pros that we talked about, just like sharks are.
Yep.
The apex predator serves a function, but there's still room for the little fishies.
The little fishies.
That's it.
It.
That's it. And surfing ocean analogy over.
Yeah. Emil, any final thoughts you want to throw in?
Yeah, just remember, we pulled some data. Institutional investors are still a very, very small part of the ownership of all the single family homes in the United States. And for anyone thinking, they're driving up prices, just remember the owner occupants who are throwing 200, 300, 500,000 over asking to get into the home of their dreams, right? They're acting on it emotionally, and there is very limited supply. So I think that's what's driving up prices, not institutional investors.
I like it. I think it's also can be my last little thought is it can be a validation of the space. So, if you have all this smart capital coming in, if someone glass half empty could be thinking, oh, they're already there. But it's like Emil said, it's a really small percentage of single family rentals that they own of the entire piece. So it's a validation. It's a price floor. It's an optimization in the space. And I think on behalf of everybody in the podcast, there's still room in the ecosystem to take advantage of it. So awesome, guys. On that note, thank you so much for listening. If you enjoyed the podcast, like us, subscribe, all of that good stuff. I would also recommend checking out roofstockacademy.com. Check out our YouTube channel. Just search Roofstock in YouTube. And as always, happy investing.
Happy investing.
Happy investing.